Hello, welcome to today's NBMDA and NAFD webinar, Getting to the Light at the End of the Tunnel. Our presenter for today is colleague Dr. Albert D. Bates of the Distribution Performance Project. Before we begin, I would like to remind the audience to please submit any technical issues in the chat box. They will be addressed as soon as possible. Our presenter will explain how to submit questions during the presentation. And now I'm going to pass it over to our presenter. Dr. Bates, please go ahead.
Great. Thank you, Stephanie. Glad to be with everybody today to talk about getting to the financial light at the end of the tunnel. I wish we were talking about how to drive even more volume in a wonderful, dynamic, growing market, but we have to play it the way it lays. Let's see if we can make the best of a bad situation. Before we get started, I got 3 ground rules. Number 1, you should have a handout. Actually, you must have a handout. And so if you have that at hand, join along. If not, stop and listen to the recording because you need a handout. Number 2, because of the way we're doing things, there's no time for Q&A, but I want you to be able to ask a question and get a detailed answer. So on the cover of the handout, 3 lines at the bottom is my email address. If you have a question, send me an email and I will get back to you privately and individually, which is the best way to answer questions anyway. I'm usually doing answers the same day. However, I am up to my ears in webinars, so it may be the next day, but I promise I'll get back to you. And then finally, the 3rd ground rule, and the most important, I am not going to tell you what to do. I have attended a lot of webinars the last couple of weeks and read a lot of articles, and they all more or less say the 5 things you have to do given the situation. Nobody knows what's going to happen. Anybody who tells you here's what you have to do is making it up as they go. What I'm going to try to do, and I hope successfully, is give you some guidelines and some structure so that you can take what you think is going to happen and your peers think is going to happen and indicate what sorts of actions might be most prudent for us. But I'm not going to tell you what to do. I'm going to give you a framework for you to do it. Good. With that said, let's jump inside the handout and see what are we going to do for 45 minutes. And on Exhibit 1, I've got 4 things I'd like to do. Number 1, I want to outline a financial appraisal of where the firm stands. I want to give you a little way to evaluate where you are on the scale that ranges from panic to relaxed. Everybody is somewhere in that range, and I want you to figure out where you are. I'm going to give you 2 ratios to look at that are crucial. There are probably 100 ratios you might look at, and feel free to look at all 100 of them. But I want to give you 2 that give you a real quick snapshot of where we are. Number 2, I want to identify what I'm calling the key mistakes in the past to be avoided. Now, key mistakes is a little strong. What it really means is key human nature things that we do. And after the after 9/11, I noticed that distributors did some things, some of which were good, some of which were bad. And I kind of noted them down. And then after the Great Recession, I noticed they made the same mistakes or took the same human behavior activities again, even though some of them were negative. And what I'm hoping is this time, we don't have the same human nature response. We may well, but at least let's know what we're doing, shall we? When we get to about the last 15 minutes of our time, I'd like to put together an action plan to say, let's make sure that next time we have a problem, we are better suited to deal with it. And we seem to have some sort of thing going on about every 10 years or so. And I want you to be in a situation where you're financially stronger the next time we have an issue like this. And then finally, about the last 2 minutes, I'm going to identify some free software. Notice the word free. Free does not mean bad or lousy. Free means free. And I've written some Excel templates that will allow you to look at your business and make some decisions, and they're actually pretty darn good, and they're available free of charge. All right, let's start with the first one, which is let's outline a way to look at your business, if we could. And to do that, we need a company to look at. And on exhibit number 2, I've got a company, and I think on your handout it's called Mountain View. It is a reasonably typical firm, given that we have 2 different industries together. And those 2 different industries have somewhat different economics. You'll have to excuse me, it's allergy season here. They have somewhat different economics, but they're close enough we can deal with them. It's a $40 million company, which makes it mid-range. So we're doing okay in terms of size. I have a gross margin of 25%, which is basically right smack dab in the middle of all distributors in the world of all products. So we're kind of in the range of typical. Down below that, I've got the expenses. And for right now, I've broken them into payroll and fringes and all other. Payroll and fringes is everybody's W-2, FICA, Medicare, retirement programs, 401k or whatever, and health insurance. So that's a fully loaded number. And notice it is almost twice as big as all other. And twice as big as all other is rent, utilities, depreciation, interest, bad debts, a whole slew of things. But payroll is the name of the game. And so as we start talking, we're going to have to address payroll. I'm not going to be a slash and burn. I'm not even a cut payroll guy. But we do need to be aware of the magnitude of payroll and what we ought to be doing to kind of think about it as we go forward. Good. If I take the expenses, subtract from the gross margin, I got a bottom line profit of $800,000 or 2%. And I think the 2% is left blank in your handout so that you can follow along. Jot it down, please. Every time I generate a dollar's worth of revenue, I got 2 pennies of profit pre-tax. So again, this is kind of typical based upon the benchmarking surveys that you folks do. Down at the bottom, I've got something that most people your size don't ever want to do, but right now, given where we are, is life and death. You need to break your expenses into fixed and variable. Now, most people don't do this, and if they do it incorrectly. So what I want to do is make sure that you know what these are, because it's essential to understanding your business. Fixed expenses, it just said automatically on your screen, are expenses that only take when action is taken, only change when you take an action. For example, if things are a little tight and you say, hey, we need to cut the travel expense, which is one of the first things we cut, and we need to cut education, which was also cut first, which bothers me since I'm in education. But if we do that, we have lowered those fixed expenses, but we have lowered them only because we decided we would lower them. In very sharp contrast, variable expenses change automatically as sales change. And this is crucial to understand, because as sales start going down, you will shed some variable expenses automatically. Most people overestimate their variable expenses, and so they think they're going to shed more expense than they do, or they don't know their variable expenses at all. I need you to do that. That's a homework assignment. It's as long as you're reasonably close, you're okay. But I would like you to give it some real thought about where you are. So there's our income statement. Now, on exhibit number 3, we have selected balance sheet items. Okay, a few items for a typical firm, and I've got 4 of them. I've got cash, and let's be honest, you're not sitting on a pile of cash. Very few distributors are. Most distributors have got enough cash to keep paying the bills, but what they are is they're not cash rich. They're not banks. Banks have cash. What distributors such as you have is a lot of accounts receivable and inventory. There's a pretty good hunk of accounts receivable, and there is a lifetime supply of inventory. Down at the bottom, I've got my accounts payable, $2,250,000. And usually when most people look at it this way, they kind of get a little ill, because I owe my suppliers $2,250,000 and only have $270,000 in the bank. No big deal, because you pay some today, some tomorrow, some next week, some next month. As long as the railroad keeps running, it's not a problem. You sell stuff, collect stuff, pay stuff. It's no big deal. It's when the railroad slows down, or worst case, the railroad stops running entirely, that things really get tacky. So what we would like to do is take the income statement and the balance sheet and say, can we figure out how we're going to look, how we're going to be prepared if the train begins to slow down. To do that, as I mentioned before, we have 2 ratios. And they're labeled on Exhibit 4, 2 key survival ratios. You absolutely must know these ratios for your business. If not, you're kind of playing it blind. The first of these is the break-even point. And this is a fairly straightforward ratio that says how much of a sales decline can we manage or experience without resorting to desperation measures. And that's what that's saying is, how low will sales go before we begin to say, you know, we really got to cut those fixed expenses, not just nickel and dime travel and education. We got to make some serious cuts. How far down can sales go before you reach that particular point? We need to know that. That's an income statement item. And then number two, a ratio you've never seen before because I invented it 2 weeks ago, the collection sensitivity ratio, which is how much can collections lag before you begin to have a cash crisis. And so it's really saying how slow can collections get, and they may well get slow as we move through this downturn. How slow can they get before it begins to eat up my cash? So we got a profit ratio and we got a cash ratio. And I believe that these two ratios will give you a very specific, strategic understanding of your business. Feel free to combine them with another 100 ratios. That's fine. The more you know about your business, the better off you are. But these to me are the big two. All right, what do the big two look like? Exhibits 5 and 6 look at the break-even point. Now, Exhibit 5 is the calculation. Exhibit 6 is what does it mean? And what does it mean is a heck of a lot more important than the calculation, but you cannot get to what does it mean until you first do the calculation. So we've got the break-even formula, and it's straightforward. It requires you at the top knowing three things. Your gross margin percentage. If you do not know that number, you do not have an accounting system, go back home and close the door. We also have to know our fixed expenses in dollars per year and our variable expenses as a percent of sales. If you have done the analysis that we talked about doing back at the bottom of Exhibit 2, you know these three numbers and we're ready to move forward. The formula is fairly straightforward. In the numerator, we got our fixed expenses for the year. Back in the old days, before most of you people were born, we used to call that the nut. It's what we have to crack each year, what we have to cover in fixed expenses before we can begin to generate a profit. And it's $7,200,000 for our typical firm. In the denominator, the reality is every dollar of revenue is not a dollar you keep. Okay? 75 cents immediately go right to the suppliers, and you got 5% variable, so my denominator is 20%. And my number is $36 million. Nice, round, even number. So if my sales fall from 40 million to 36 million, I'm going to make zero profit. What's the implication? The implication is in Exhibit 6. And what it says is top line. We will go to break even if sales fall by 10%. I have used the magic of technology to put a line on your screen. Write this line down on your page. A 20% safety factor is the goal. We need to have in the future, we can't do anything about it now, but in the future, we need to have a 20% safety factor. Why did I have that number? Well, after 9/11, I came up with a safety factor of 10% because I was brilliant and knew everything about distribution, and I knew I was right. After the Great Recession, a lot of distributors' sales fell by 20%. And so I said, you know, maybe I'm not quite as brilliant as I think I am here. So I went to a belt and suspenders view of life. And my belt and suspenders view of life is 20% will get you through most situations. Not guaranteed, because there could still be something that's the end of the world, but for most situations, 20% will get you there. Going back to your numbers, 10% decline in sales, 10% decline in cost of goods, 10% decline in gross margin. If we've not moved to the point of cutting anything, not even training and education, the fixed expenses stay the same. The variable expenses go down right along with sales because they are 5% of a smaller number. And lo and behold, we break even. Before you leave Exhibit 6, this is crucial to understand, so please listen. This is for an entire year. This is not for April, because April could be a wipeout, but it's for the entire year, what you think the entire year is going to look like. Now, January and February should have been nice numbers. The economy was on a roll. March, for most distributors, was a mixed month. April is not a month to write home to mom about. I'm aware of that. But what I want you to do is take January, February, March. You got a quarter already on your belt. April and what you think is going to happen. If you think the world's going to be terrible for a long time, you're in some trouble with regard to Exhibit 6. If you think it's going to recover at a reasonable rate, Exhibit 6 gives you some ways to say, hey, I think I'm okay. But first, you got to do the calculation for your own company. Great. Let's look at the second ratio if we could, which is a cash flow ratio. It's on exhibit number 8, but before I can get to exhibit 8, I got to go to 7. I need to calculate two ratios on exhibit 7, which let me set up exhibit 8. Exhibit 7 has two ratios. Let's look at the bottom one first. The bottom one is the collection period, or the DSO, the days sales outstanding. How many days does your typical credit customer take to pay you? You look at this all the time. It's a classic ratio. You look at it every month probably, maybe every week. So we know that ratio by heart in terms of what it tells us. At the top, there's a ratio that's actually needed to calculate the collection period. It's just built into the calculation so you don't see it. It's called collections per day. How much money comes in every day from the fact that we've sold things and we've not yet collected? Let's take our annual credit sales, and let's assume everything's uncredited, 40 million bucks, divide by 365, and every day we get $109,000 of cash. It may come in by checks. It may come in by cash. It may come in by a guy bringing you a satchel full of $200 or $100 bills. I don't know, but it's $109,000. So every day I carry people, it's $109,000 of investment. The collection period says, hey, we got $3 million in AR. That's our AR number. And 109,000 represents one day. So if I calculate that out, I'm being paid in, I believe, 27.3 days in the world. Great. Now, I want to go to exhibit number 8 and calculate this ratio. I'm going to take my cash on hand, which is $270,000. I believe that was back on good old exhibit number 3. 109,000 represents one day, and I can be paid 2.5 days slower without running out of cash. Now, it's not as bad as it sounds, because you might also delay your payments to your suppliers. You might have a line of credit, and a line of credit's fine. I, however, am a little bit concerned about the line of credit, simply in that maybe my line of credit gets canceled because banks have no sense of humor, and banks sometimes don't have any idea what they're doing. If I take 2.5 days and divide by 27 days, which was my collection period, I can have about a 10% decline in how fast I collect. I'm going to have the same magic number I had before. I'd like to see this be about 20%. So I'd like you to be closer to 5 days that you could take a hit rather than 2.5. But again, it is what it is. You've got to calculate it for where you are. So those are my two magic ratios. Combine that with your other ratios and look at your business systematically, thinking about where you are. Take a deep breath. Try not to hyperventilate and go to exhibit 9. On exhibit 9, it says the volume sensitivity of 3 profit groups. I've taken your benchmarking report, which is a nice report, and I've broken into the typical, high profit, and low profit companies. Typical is the mid-range company, right smack dab in the middle, half do better, half do worse. And it's got a profit margin at 2%. And I said we could take a 10% hit before we reach break even. Interestingly to me, the high profit group doesn't do a little bit better. They do a lot better. They got a 6% bottom line, and they could actually take a 30% hit before they had to panic. That's a nice number, really a nice number. I'd love to see you there going forward in the future. Now, you don't calculate low profit in your survey, but I just gather the data up and look at it anyway. There's some people who got a bottom line of about 1%, only a 5% safety factor between current sales and break-even sales. We need, moving forward, to be in the high profit category. And I want every one of you to take an oath that going forward, we're going to figure out how we're going to be high profit. We'll talk about doing that in about another 15 minutes. But for right now, we're going to address the second issue, which was, what sort of mistakes do we tend to make? What sort of things do we do over and over? And again, not necessarily mistakes, but because we're human beings. And human beings tend to do things the same repetitive sort of way. To set this up, I've got a graph, and it's a little bit complicated, but I think you'll figure it out. The graph is on Exhibit 10. The title of my graph is The Relative Impact of Improvements in the CPVs on Profit Before Taxes. CPV stands for Critical Profit Variables. Those things that drive profit, and there are 5 of them: sales, gross margin, expenses, inventory, and accounts receivable. Those are the big 5. Nothing else really matters. And then what we're going to do in this graph is we're going on the vertical axis, look at our PBT, which is currently 2%. Yeah, 2%. So we're going to look at that particular number. And then we're going to, on the horizontal axis, says, what happens if I do 5% better, 10, 15, 20% better on these CPVs? Now, 20% is knocking them dead. So we'll kind of stick with 10. And let's start at the bottom 2 lines, if we could. And there's 2 lines that are almost on top of each other. They are inventory and accounts receivable. And what it says is if we lower inventory and accounts receivable without sales going down, if we lower inventory and accounts receivable by 10% without sales going down, PBT does not go up much at all. That's a truism. You don't believe it. Inventory and accounts receivable are gigantic drivers of cash flow, huge drivers of cash flow. And if you have too much inventory and too much accounts receivable, you're hurting. They are not drivers of profitability, and I'll prove that in a couple of seconds. Coming up scale, there's a little line that looks like it's aquamarine or something. That's the sales line. It says, hey, if we did 10% more sales, we'd drive PBT up to 3.5%. It's not as steep as the 2 lines above it because if you recall, we have variable expenses. And as we sell more, we have more variable expenses. Just like we said, if you lower your sales, not your decision, the economy lowers your sales for you, the variable expenses go down. If you sell more, the variable expenses go up. It's a nice line, though. Above that is the expense line. Notice that the expense line says that reducing expenses by 10% has a larger impact on profit than raising sales by 10%. That's terrible news, but it's also true. So of the CPVs, expenses is more important than sales. That says nothing about market share, because if you drive more sales, you can gain share. It says nothing about motivating employees, because employees can be motivated to drive more sales. It's not that easy to motivate them to cut expenses. So it's got good things. It's a powerful CPV. It's got negative ones. It's not a really thing you like to think about. And then finally, the top line is gross margin. Single biggest driver of profitability on the face of the earth. Given that, I want you to remember that hierarchy: margin, expenses, sales, inventory, accounts receivable. Let's look at what sort of mistakes do we make. And on Exhibit 11, the single biggest mistake in every recession is we decide to cut price to help hang in on volume. This particular graph says on the vertical axis, make that horizontal axis. On the horizontal axis, if we cut price 1%, 2%, 5, all the way to 10, on the vertical axis, it will then tell us how much do we have to increase our unit sales. That is the physical volume of stuff sold, not the dollars, the physical volume, to keep profit right where it is. And what that line says is, hey, on that particular line, everywhere on that line, profit will continue to be $800,000 because that's what it is right now, $800,000. If I go over to the 5% line, just let your finger go up there and go over, it says, hey, if we cut price by 5%, we got to do about 35% more volume. Folks, the business that you're in, the way it is structured right now, it is probably impossible to make it up with volume. I'm also going to tell you one little quick war story. It's the only vignette I will tell in the entire program, I promise. There was a wonderful story on the news the other night about a guy who ran a food truck, still runs a food truck, outside some office complexes, okay? And he's got that office complex, and he's got that food cart running out there. And he, on a typical day, he was doing about 100 meals a day. 100 meals a day. Wow. But then the coronavirus hit and said, oh, gee, I'm only doing 20 meals a day. I've got to do something to get this volume back. So he cut the price, okay? He cut the price. And then when he cut the price, he noticed he did 20 meals a day. It made no blooming difference. None whatsoever. No blooming difference. And that's a moral. Folks, when people are not buying, they are not buying. And you can cut the price all you want, and they probably will not buy unless there's somebody who's sitting on more cash than they know what to do with. And they will, in fact, buy a whole bunch of your stuff at too low a price. Exhibit 11 is across the board. It is across the board. Now, most people are not going to cut across the board, but let me tell you, the problem you have is your idiot competitor who has no idea what he is doing is the one most likely to cut. And your challenge is, what do I do as a result of this? What do I do as a result? How do I manage this? And the answer is you've got to be selective. If you're forced to cut because he is an idiot, you got to be selective. That selectivity is on exhibit number 12. And what it does is it takes all your items and arranges them by velocity code, A, B, C's, and D's. A's are high tonnage items, probably commodity-like, 60% of my sales. B's are pretty good items, basic items, another 20% of my sales. C's are slow sellers, about 15% of my sales. And D's are really slow sellers, the bottom 5% of your sales line. So I've got that situation. If my competition lowers 5% and I feel I have to match them on the A's because those are items that are really price competitive and I got to meet them, okay, that's a problem. The next three lines down say I could keep the gross margin right where it is, which I believe is 25%, if I did all three of these things. Raise the B items 5%, raise the C 6.7, and raise the D's by 20. I've argued for a long time that most distributors dramatically underprice the D items because what you're selling is you have it when they need it. And I think the 20% you might be able to do. I don't know about the 5.0 and the 6.7, however. That's your challenge to figure out what you're going to do about it. But at least this tells you here's the hierarchy. And if you only cut price by 1%, divide all those by 5. Per day, I believe 109,000. That number is still correct. What I did is I used one association's number for one exhibit and a different association's number for another exhibit. So, hey, I've hosed it up. Live with it. Let's assume my collection period is now 18.3 days, not what it was in the other exhibit, 18.3 days. And if I have collections per day of 109,000. That's how much money comes in every single day. And if I collect in 18.3 days, I have to have $2 million of accounts receivable, which is the number that was on exhibit number 3, but wasn't the exhibit that was on number 7. Okay, let's go with it. Suppose we said, hey, you know, boy, I'm going to have a cash flow problem. I need to cut the collection period. Let's cut it by 5 days. Let's cut it from 18 to 13, 5 days, with a mega assumption, not a small assumption, not a big assumption, a mega assumption. We're going to have no decline in sales from cutting the collection period. May be true, maybe not be true. I take the same 109,000 times 13.3. My new AR is going to be $1,450,000, which means I'm going to lower AR by $542,000. That, from a cash flow point of view, is a home run because I only had about 270,000. That's a 200% increase in my cash. And I said earlier, inventory cash flow, gigantic impacts on cash. What's the profit implication, though? Well, there's a carrying cost on accounts receivable. You probably know full well there's a carrying cost on inventory. There's also one on accounts receivable. It consists of interest, bad debts, and hounding. I put it 8%. It's a lot lower than that in today's environment, but I'm assuming interest rates someday will return to normal. So I've used 8%, and 8% of a $540,000 reduction. You've increased profit by $43,000. That's not bad. It's not terrible. I've increased profit by $43,000, which if I remember out there, I had a reasonable profit before. I think it was $800,000. It's okay. It's not big. Let's ask the question on Exhibit 14, though. What is the relationship between collecting faster and having a big improvement in cash, but a small improvement in profit versus what if I lose some sales? And so exhibit number 14 has got a break-even formula. It's the same one we looked at before, just dressed up a little bit. And I'm going to put the numbers in so we see them from the start. We had fixed expenses, expenses that only change if you take an action of $7,200,000. We have a profit of $800,000, and we just made a reduction, we just made an increase in profit of $43,000, but we're going to subtract that because we're going to ask ourselves, how much do sales have to go down? The denominator is the same as it was before. Let's go to the implication. Write this down, please. On Exhibit 14, the lower right-hand corner, there's a number that flashed up there, minus 0.5%, minus 0.5%. And what that says is if you cut 5 days off your collection period, that would be wiped out from a profit point of view if sales fell by 5%. This doesn't say what you should do. I told you, I'm not going to tell you what to do. What I am going to tell you is this is a trade-off that you need to be looking at and analyzing and understanding in your particular business. If not, you do not know where you're going. Should I cut collections? Should I not cut collections? What should I do? You're the management. You get the big bucks. You got to make a decision. One more thing on mistakes that we make, and it's on Exhibit 15 and 16. And the last mistake is we tend to issue an edict when sales get soft. Stop buying. I told you I was not going to tell you what to do. This is the one exception. I'm going to tell you what to do. Do not utter the words stop buying. If you do, I'm going to come through the computer screen and strangle you. It is the worst thing we can do in a down market. The problem we have is that inventory is unlike anything else in the business. And that is, there's two ways to go. There's more inventory, less inventory. If we look at providing customer service, that's a thing that says we need more inventory. If we look at financial stability, that's the thing that says we probably need less inventory so that we're not up to our ears in inventory. Now, we have a measurement tool. The measurement tool for customer service is our fill rate or service level. Our measurement tool for financial stability is inventory turnover. Here's the rub, and it's a big rub. It is difficult to impossible to calculate the fill rate. It just is. It is very easy to calculate inventory turnover. I own a copy of Excel. I can calculate inventory turnover to 64 decimal places. The reality is if you've got two ratios, one is easy to measure and one is hard to measure, you will move towards the easy to measure, particularly in a down market. And fill rate says we need more inventory to maintain sales. Inventory turnover says we need less inventory to maintain financial stability. And we have little slogans, little mantras. The Salesforce says this all day. Can't sell apples in an empty cart. And the financial guys run around shouting cash is king. I believe that we need to control the inventory so we're not up to our ears, but do not issue a stop buying edict. That's because on Exhibit 16, I've got some bad news from you. You're not going to believe this, but I'm going to give you this bad news. People do not buy from you because you're good looking. They buy from you because you have stuff they want. And if you stop buying, the first thing you will run out of is things that they really want to buy. Exhibit 16 is some research that's been done in industry after industry after industry in distribution. And it asks the question, what do customers want from their distributors? These are in order of importance. The single most critical factor is, I want you to have a good fill rate. Number 2 is I want you to have a wide assortment, one-stop shopping. Number 3, I want you to get it to me quickly because I actually should have told you 2 days ago and I didn't. Number 4 is I'd like it to be accurate. I'd like it to actually send what I ordered. And number 5 is pricing. This is crying out that we need to maintain the fill rate. The ideal way in a down market is to get rid of the junk. The reality is nobody wants junk, even in a good market, certainly not in a down market. Do not issue a stop buying edict. Number 3 on our hit parade of things we're going to do is suggest an action plan so that the next time we have a problem, another 10 years at least, I hope, is that we do not have the same challenge now. I want you to have a 30% gap between where you are in sales and your break-even point. I want you to be high profit. What do we have to do to be high profit? And Exhibit 17 says the first thing we have to do is worry about employee performance and payroll. Exhibit number 17 has 2 ratios. At the top, we have sales per employee. This is total sales volume divided by every man, woman, and child that works in the business. And in the year of our Lord 2014, it was 585. In 2018, it was 635. Went up by about 8.5%. That's not terrible. It's not sensational, but it's reasonable. I can live with it out there. It's productivity improvement. We didn't have a problem with productivity. We improved productivity slowly and steadily. However, if we go to the bottom of Exhibit 17, this is interesting. Payroll as a percent of sales actually went up. That's a problem. Do not feel like you are the only company in the world. Every line of trade and distribution has the same problem. Productivity is improving, but payroll as a percent of sales is actually getting worse. There are about 3 reasons. Number 1 is productivity is good, but not great. Number 2 is, if you recall back before things got terrible, you could not find employees at any price. So there was an upward pressure on wage rates. And number 3 is, I think I've already forgot. Yes, I remember what it was. Number 3 is, I'm not sure of this, but I understand health insurance has gone up. Okay, those factors combined to create a problem. Well, how do we get out of this? I've got 2 ways to get out of this. Exhibit 18, the first way to get out of this is unique to your industries. Other industries have it kind of like this, but this is more severe in your industries than it is any other place. What we've done on Exhibit 18 is we've taken payroll and broken it into 4 categories. And we've done 2 things with payroll. We've looked at it as a percent of sales, and we looked at it as a percent of total payroll. And those 4 categories that we put out there are officers and owners, sales force, operations, warehouse and delivery, and all other back office, et cetera. Now, if we look at percent of sales, officers and owners are 2.5% of sales. And I can say, let's cut those, but you would not be pleased with that concept. Salesforce, oh my God, 7% of sales. Operations 3, all other 2.5. If I look at percent of payroll, owners and officers are 16.7, plug that Salesforce number in, 46.7%. We are way off where I would like to be with regard to Salesforce compensation. Now, Salesforces are crucial. Absolutely. Got to have them. We got to rethink how we have them. One of the problems that we have with regard to the Salesforce is we need more people in sales in the American economy than there are people who have selling skills. Selling is an incredibly difficult job. Most people don't have those skills. And I will guarantee you, out of every 10 salespeople in the world, 2 of those salespeople really ought to be accountants. What you need to do is go back and look at your sales force and make sure you're getting productivity out of everybody. If you have a doofus in the warehouse, you can live with it. You can work around it. If you have a doofus in the sales force, he is costing you money by not generating sales every single year. And most people tell me, Al, hey, come on. It costs me money to replace a salesperson. Yes, that's a one-time cost. Not getting sales is an every year cost for the rest of your life. Now, maybe we have to rethink whether we need salespeople in certain situations. I'm not going to go there. All I'm going to tell you is this is an area you should be looking at. The second area you should be looking at going forward is your customer set. And again, I don't know if this has been done in your industries, but it's been done in a lot of distribution industries, and it comes to the same conclusion every single time. And that is that we can take all our customers and ask ourselves, how much profit do we make off of them? And we get 4 categories. High profit, sensational profit. Good profit, good is good. Some is slight, and unprofitable, we lose money. The high profit customers are about 15% of our customers, and they represent the equivalent of our entire profit. And I believe our entire profit was $800,000. If I take my good profit, another 15%, and they give me 35%. Well, we don't get that because we give it away at the bottom. The some profit, a third of my customers give me 10% of my profits. And finally, unprofitable. It's only about a third of your customers. Don't worry about it out there. And these third of the customers cost me 45% of my overall profit. If I make $800,000 and I get my calculator to actually work times 0.45, I believe I'm losing $360,000. There's 2 things you should do. Number 1 is you go to those good profit customers and send them a Christmas card. And number 2, you need to look at those unprofitable and ask some questions. What do we do? There are 2 things you can do, and it's on exhibit number 20, which I believe is labeled exhibit 241. Again, I've been doing too many seminars, 2 a day for the entire week. It's exhibit number 20. Fire them. I'm not a fire them guy, but there are some guys out there who are saying you ought to fire those customers. I don't think so. But I am going to tell you, about 2% of your customers you ought to fire. These are customers that the analysis shows they know you lose money. They're glad you lose money. They're going to keep helping you lose money. You need to get rid of them. But it's only 2%. And there's, a couple of ways to do it. One is to tell them flat out, I never have liked you. I don't think that's a good idea. The other is simply keep raising their price. Systematically, slowly, but definitely systematically until they might become a problem, or they wise up and go become a problem for your competitor. The bigger issue is you've got a bunch of customers. After you fired 2%, I believe you've got 33% left. You've got to change their behavior. That's a major workload. You've got to get them to buy less frequently. You've got to get them to buy more each time they do. You've got to get them to have fewer emergency orders. You got to get them to have fewer returns. It's a lot of work. It's something you need to do because I do not know any way to make productivity by itself work. I've got to change the nature of the way we do business. All right, I promised you about the last 5 minutes. I would talk about some free software. We got 5 minutes left. I'm going to talk about some free software. I have got on my website, on Exhibit 21, it is labeled Free Planning Help, distperf.com. That's my website. If you toggle over to the Programs tab and then scroll down to Hands-On Tools, you'll find there's about 5 or 6 Excel files. They're all free. One of them is what-if analysis, and this is really relevant right now because it allows you to plug in to say, hey, what if my sales go down 10% and I cut my prices 5% and I do this, that, and the other? What do I look like? It is sensational for uncertain times like right now. There's also one for price-cutting economics. If you recall that little curved graph, how much more do you have to sell if you cut the price? It'll calculate that for your company. There's business valuation. I never liked this one, but if you want to sell your business, it'll tell you what it's worth. There's understanding the CPVs, critical profit variables. We had a graph with 5 lines. It will duplicate those 5 lines. And then finally, profit first planning, which I'm going to talk about for a couple of minutes in a second. These are all out there on my website. If you go there and try to download one, you will get a message that says, this is password protected, and you have to send good old Al an email. I will then send you the passwords. That will be the only email I will ever send you. I will not send you any promotional material. I will not do anything. I don't work that way. So they're there for free if you'd like them. Let me talk about this last one for about 2 minutes because I think it's really crucial to getting to that long-term position where you are a leader in the industry on profitability, not just some years, but every year. Exhibit 22 says, how do we plan? And usually the way we plan is the following. We start with sales. That's the first line on 22 so far. We start with sales. It's the top line of the income statement. Of course you start there. Then we figure out our gross margin. Then we figure out our expenses. And then we know profit. Here's what's wrong. Profit is you take sales, subtract cost of goods to get gross margin, subtract expenses to get profit. Profit is whatever is left over after you stop subtracting. I think it's a dumb way to plan. The way I'd like you to plan is I just put a line on Exhibit 22, plan your profit needs first. This is what's called profit first planning. It is incredibly controversial, unbelievably controversial, because people tell me you can't know how much profit you're going to make until you know your sales. And I answered, oh, yes, you can. Because if you figure out profit, then you got to say, how much do I have to sell to get to that profit? How much margin do I need to get to that profit? What do I have to do to control expenses? Again, extremely controversial, but listen to this statement clearly. Companies that have gone to profit first planning always dramatically improve their bottom line. That's a strong statement. And if you want to be a profit leader in the future, you at least got to look at this. You don't have to use it, but you at least got to look at it and say, I don't want to do it. Let me spin one exhibit on Exhibit 23, and then we'll be moving towards conclusion. The Profit First template. What this says is, what does this template look like? Okay, at the very top, it says Goal 1, planning profit first. Okay, it's the first thing that pops up. Go down to the little box. Little box has about 5 or 6 lines in it. The first line says, you're now making $500,000 because you told me that. Your current ROA is 5%. Down below that is a box that's in yellow, and you can put a number in there. The other numbers you can't put in there. They come up automatically. Excuse me. Allergy is terrible. So I said, hey, I want to make $600,000 next year. That's the first thing you do, planning profit first. It then says, hey, you're going to bump your profits by 20%. Your new ROA is going to be 6. Then down at the bottom, notice this, Profit Guru. What I have done is I've had my brain surgically removed and put into an Excel file. And it says, hey, this is a small change, puppy. You're sandbagging. A typical one-year change is between 2 to 3 points. Rethink it. Okay? It's telling you this on every step. Profit, sales, margin, expenses. It gives you guidelines about what you can do. It's pretty nifty, if I don't say so myself. Let me do a 30-second sales call, and then I will give you some conclusions, and we will depart. I wrote a brilliant book. If you'd like to know more about profitability, it's called Breaking Down the Profit Barriers in Distribution, available from Barnes & Noble and the hated Amazon. Okay? I'd love you to buy it. Every manager should read this book, which is why I'm only asking is every one of you buy 20 copies. Let's conclude. I don't make sure we know what we did and why we did it. We said that as we're going into this market, we do not know what's going to happen. I don't, you don't, nobody does, but everybody's getting some ideas, and the more data we get, the better our analysis is. In order to see whether we should panic or relax, we need to calculate 2 ratios, break-even point and the collection sensitivity ratio. You can do those. They require you to first figure out your fixed and your variable. The second thing we said is we tend to make the same mistakes over and over because we're human beings. We cut the price when we shouldn't. We cut the accounts receivable collection maybe more than we should, but I don't know, maybe not, but we tend to. And third, we tend to stop buying. Got to avoid those mistakes. We said going forward, we needed to improve profit, and probably the 2 best areas to do that. The low-hanging fruit are get control of the sales force and look at your customers and how they're contributing to your profit. And then finally, we said there's some free software available to you. I hope you go out and take advantage of that software, and I hope you do everything you need to do 2 things. Let's make more money, and let's stay safe. And I hope you do those 2 things because you're nice people. I enjoyed being with you. Thank you very much.
I'd like to give a big thank you to our speaker today, and we'd like to thank our presenter and everyone online for attending the event. Thanks again for attending today's webinar, and you have a great day.